It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show, and today I think I'm going to cover, I promised last week that I was going to talk about how to create interest from the cash flow that comes into your business or your home, for that matter, how to earn interest on that. And I'll touch on that today briefly because I promised I would last week. But first, before I get to that, I really want to, touch on the question that I've been receiving the most this past week or two, and that is I'm getting a lot of people that are getting really concerned about inflation. If you haven't heard already, the latest numbers were that inflation numbers were officially from the government. Now understand, first of all, the numbers came out at 4.2% on an annualized basis, which was higher than expected. But what I would say, my first comment would be, why would you be surprised? I mean, the reality is, as I've been saying on the show for quite some time now, repeatedly, is you can't pump $6 trillion of additional monies into the system, which is what's happened over the past year or so, starting from the first coronavirus relief package to now. You can't pump $6 trillion into the system and not expect some kind of repercussions from that. I mean, to put things in perspective, about $4 trillion is the annual budget and that the federal government deals with on an annual basis, and they bring in, depending on the year and what's going on, probably somewhere between that $3 to $4 trillion of revenues. So, again, when you start talking about trillions, here's the biggest problem. First of all, a lot of people just kind of go numb because, well, those are incomprehensible numbers. And to be fair with you, I'm a financial guy. I deal with numbers every day, and they're incomprehensible to me too. I mean, I don't think anyone can fathom that type of that many zeros. We'll put it that way. To put things kind of in perspective, if you break it down, you just chop some zeros off, and I found that it breaks it down a lot easier. And so what it means is, if $4 trillion a year, if you break that down to say, in the terms of like somebody's household income, let's say somebody's annual income was $40,000 a year instead of $4 trillion a year. All we're doing is chopping off some zeros here, right? So let's say your income was $40,000 a year, to make things simple, okay? And based on the government numbers that they say today, they've spent, a year and a half's worth of, or 18 months worth of annual income. Okay? Well, when you spend that kind of money or put it into the system or print it, all the things that they've done to dump it into the system, it's like dumping, in essence, more than double, about 2.5 times into the system what's normal. Okay? The cost of goods and services are going to go up. They're going to increase. Now, the other part of it that's, again, to help understand that the government states right now they owe about $28 trillion. Again, another unfathomable, incomprehensible number. That would be like somebody who earned $40,000 a year household income, owing about $280,000. I mean, that's a lot of debt to service. They're very much upside down, and even if they put 100% of their income towards the debt, wouldn't be out of debt for quite a few years. If they put 100% of it away, it'd be something like 7 years or so, give or take, just to pay off the debt. So it's not even a feasible option to pay off the debt. They just have to pay the interest on the debt. Here's the other part of that that's scary is that I've seen some studies by some economists already who are sharing that if the federal government does not spend any additional monies in addition to what they've already spent, that they're either going to have to increase taxes or reduce benefits just to cover the interest on the debt alone, just the interest, not the principal. Okay, and that they have to pay. Otherwise, we talk about default scenarios and all types of catastrophic financial ramifications. Okay, so I've got off on a tangent here a bit, and I didn't mean to do that, but it's all this kind of stuff that's going on in terms of, I've always been a fiscal conservative. I've always been frustrated for decades now of the level of government spending. And it's just increased. Every administration, regardless of the political party in charge, pretty much every administration has spent more than the previous. And it's gotten to the point now where it's just completely unsustainable. The amount of spending that's going on now literally will force dramatic and significant financial catastrophes if some things aren't changed, the course isn't changed and changed quickly. And I'm talking about things like, it wasn't that long ago, austerity measures for Greece, for example. Things like that is what I'm referring to. So what I'm getting at is the question I get the most often is, hey, inflation is here. And the thing you need to understand is when the government says inflation is 4.2% first quarter on an annualized basis, understand the consumer price index, what they're using, takes out some of the most common and basic increase of prices of things that the average American actually uses, and that's things like food. Okay? It's not even counting those things. I've seen some things already showing that the cost of beef has increased by something like 40% across the nation, corn 50%. I mean, these kinds of things have significant impacts on people's, it's on what they have to spend and what they have to keep, right? And in essence, it's like a tax, but it's even more insidious because it's like hidden. You don't even know it's there. You just notice when you go to the grocery store how the cost of things increase. And building materials is another area that is tremendous, has seen tremendous increases. As I stated in a previous show, one of my contractor clients talked about a sheet of plywood being $9 a year ago, and today it's $43. Okay, that was just literally a few weeks ago. So the question I get asked, I keep getting back to that, is what about inflation? What about, those types of things? Your personal bank, I talk to people about this concept all the time about setting up a high cash value policy and then accessing, the funds from the policy through a bank line of credit using the cash in the policy as collateral to get positive arbitrage. And the dividends that are being paid right now are in the 6% range. We got companies that have been paying that high 5s or 6 for the last 25 years. Never missed the dividends since literally before the Civil War. A-plus rated, tons of cash reserves, well-positioned to continue to pay solid dividends for the foreseeable future. They did it through the Great Depression. They did it through world wars. They've done it through every type of national or economic catastrophe or whatever you want to call it, change that we've experienced as a country. And they're continue just to pay those dividends and continue to be well situated to do that. We can go into the reasons why they're able to do that, maybe in another show. And if you want more, if you want to know why or how they can do that, how they can pay such consistent dividends, contact me at yourpersonalbank.com. Shoot me an email, whatever. Be happy to chat with you about it or answer you on the via email or on the radio for that matter. We'll probably cover that on a future show in the near future, I should say. But what a lot of people are concerned about is, okay, I get the positive arbitrage. The dividends are earning up to 6% currently. Okay, the lines of credit are 3 to 3.95, so the positive arbitrage scenario is between 2 and 3%, basically. But what about when interest rates change in the future? That's the big question. Folks, here's the thing you need to understand. If you haven't experienced this before, then I brace yourselves because I firmly believe we're going to see more of this in the future. To what degree? Have no idea. I can't predict that. I'm not here to scare people or anything else. But again, you put that much money in the system, you're going to have inflation. You're going to have the increase of costs and services, okay? And that also pushes interest rates up. Our Federal Reserve has kept our interest rates at an artificial low level, historically low level now, for over 12 years, basically since the Great Recession, 08-09. I've seen some things recently that have pointed out that we're in the lowest interest rate environment since 1787. That's the history of the country, folks. We've seen the lowest interest rates ever. I firmly believe, and everything we're seeing is clearly steering that direction, that's going to be changing in the probably sooner rather than later. Exactly when, how much, I can't say right now. That's impossible to predict. But even Janet Yellen, our Treasury Secretary, has discussed already some inflation. Our Federal Reserve Chair has brought that up briefly a little bit. They're even using the words, and the markets have reacted. If you've paid attention to the stock markets and stuff recently, there's been some real jitteriness about it because higher interest rates, generally speaking, is not good for the stock market. That's a pretty fair, frank, solid statement across the board. Higher taxes in general are not either. So the Biden administration has repeatedly and consistently stated they want to increase taxes in a myriad of ways. And again, those are not things that are generally conducive to a strong economy. Inflation and taxes, that is. Higher inflation, higher taxes. It's not generally good for the stock market and, profits of companies, which is basically what the stock market is based on, right? So where do you go? What do you do? And how does your personal bank fit into that? Well, first thing I'm going to say is it's an outstanding alternative or diversification strategy. It also happens to be income tax free. We're going to touch on that in the next segment, so I'm going to encourage you to stay tuned. Or again, contact me at yourpersonalbank.com for more info. So again, from a tax standpoint, from a market risk standpoint, it's a very strong diversification strategy. And I'm getting more and more interest on that, frankly, by the week. Okay, I've always stayed consistently busy with my career. I've been blessed in that way, and I believe part of the reason is there's several reasons why, but one is I've always reached out to a lot of folks consistently, and bottom line, I have a lot of folks reaching out to me now because, well, when I meet with them and talk to them, I really listen and really try to take care of their needs and their goals and accomplish what they're really trying to accomplish, and offering solutions, true solutions, not just with what your personal bank can do, but across the board, a holistic approach, if you will, for their finances, personal, business, taxes, all of it, whatever. So that's blessed me with staying busy, but there's definitely been an uptick in activity and concern. And again, it revolves around higher inflation, higher taxes, that it's increasingly looking strongly that we're going to be dealing with. So stay tuned in the next segment. We're going to talk about this further and how your personal bank can help offset those risks.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're talking a lot about, the most common question that I've been getting the last few weeks, and that is, what will inflation do to my money, my investments? How are the higher taxes going to affect things? How do I adjust for that? How does your personal bank fit in that? Because the reason people contact me, primarily one of the most common reasons, is they look at it as a alternative diversification strategy, something that's not correlated to the markets, for example, or real estate or cryptocurrency or any of those other types of things that folks may be invested in. So it's a great diversification strategy. It's interest rate sensitive. Now, see, the last decade or so, that's actually been a weakness because the interest rate environment has been so low. In fact, historically low. This is the lowest interest rate environment we've seen, based on everything I can see, is the lowest interest rate environment we have seen since 1787, which means the history of our country. The fact that we have companies still paying dividends in the 6% range, high fives and 6%, is incredible. The fact they're paying dividends every single year and never missed, and paying those for the last 25 years and never missed paying dividends since literally before the Civil War, is incredibly impressive. So, given the incredibly low interest rate environment we're in. Now, if you're looking at higher inflation in the future, and I think that's becoming increasingly likely to be a fact. In fact, if you haven't already known, most people have already heard that, we had a 4.2% inflation rate first quarter 2021, and based on an annualized rate, which is higher than expected. Like I said, I don't know why anybody was surprised. Frankly, I wasn't surprised at all. You pumped $6 trillion extra dollars into the system of COVID relief related, whatever you want to call it, monies, federal monies. In other words, printing dollars, pumping that into the system. Why would you think there would be no recourse? How could you not think prices would go up? There's more dollars chasing goods and services. And I'm talking about things like food, clothing, housing, the basics. Okay, those are the things that are going up. Those are the things people are spending money on, and there's more dollars to spend, or more dollars chasing those. So it wasn't a surprise. But the reality is, like I said earlier, the fact that we've been able to offer 6% dividends through this unbelievably low interest rate environment, the lowest in the country's history, is, again, impressive. What were personal bank policies dividends? What were they paying prior to this low interest rate environment? And this is very enlightening. This is where it really starts to open people's eyes and help them understand how this can be a very powerful diversification strategy, very powerful diversification tool. And here it is. If you look prior to 08-09, and I've got a chart to show this, so if you want to contact me at yourpersonalbank.com, I'll be happy to share that with you. I'll show you all the top dividend-paying companies, not according to the insurance industry, but according to the banking industry. This is very important. I'll share why in a minute. But pretty much all of them were paying 7 and 8% prior to 08-09. That was normal. Okay? 7-8% dividends was typical, and that was what most would consider a normal or average interest rate environment. Prior to that, when there was interest rates higher than that, we saw double digits in dividend rates. So my point is this. Why is this so important? Well, it's pretty much common knowledge that higher interest rates and higher taxes are not typically good for the stock market and for companies and the stock prices and various things like that. Just go back in history and just look at the history. I mean, it's pretty obvious. There is no question the stock market has been in a tremendous growth curve for the past decade or so. A lot of that, frankly, was fueled by the incredibly low interest rate environment by the Fed. The situation that we've been dealing with, if you look over the last couple of decades or so, which is basically my career in the financial world, I started in 1997, I guess. We're going through significant boom and bust cycles. I don't think there's anyone that can argue reasonably that we're not in another bubble. Another bubble has been created, particularly in the stock market. Stock prices are, all-time highs and breaking all-time highs on a regular basis. Now, most recently, we're starting to see some real concern and jitteriness in that, and that has to do with, again, the concern about inflation. Inflation is a bitter pill for company profits. Inflation reduces profits, all kinds of negative things for companies and their profits, which affect stock prices. This is basic economics 101. There's nothing complicated about that. And so the predominant source of wealth, building wealth over the past decade or so, I think it'd be pretty hard to argue that for most Americans has been the stock market and maybe secondarily real estate. Those have been two of the big ones. Well, guess what? Higher interest rates causes problems with mortgages and loans, so that can affect the value of real estate too. So there certainly can be, inflation can help the values, but also hurt in the lending. So it can be a double-edged sword for real estate. Higher taxes also can be that way too. My point is, if you're looking for reducing market risk, reducing taxes, and looking for something that's interest rate sensitive, which actually is a positive with higher interest rates. Again, Your personal bank policies, dividends that were paid prior to 0809 were 7-8% was normal. Okay? And double digits, if you go back farther than that, where we had higher interest rate environment. There are some people that are getting very concerned about what's going to happen. I've seen stuff like return to the 70s and things like that. Look, I don't know if that's going to happen. I certainly hope that does not happen and things don't get that extreme. But the reality is, if interest rates jump up, climb, your personal bank policies and the dividends will be one of the strongest assets you'll own probably, because your dividends will be stronger. You'll get paid more. And even with the positive arbitrage, even if the interest rates climb, historically speaking, the positive arbitrage between the dividends paid by the insurance companies and the interest charged by the banks when you access the funds historically has been about 2-3%, irregardless of whether we're in a low, average, or high interest rate environment. See, that pretty much answers the number one question I've been getting, like I said, particularly in the last few weeks. As inflation concerns are increasing with a lot of people and increasing on a daily, weekly basis, as personally, I think they should be concerned. I think really what it boils down to is the direction our country is going, financially speaking, there's a change of direction. What's been going on for the past decade or so is probably not the same results we're going to see the next 5 or 10 years, because we've got a dramatically different financial scenario going on. We're in the era of big government. We're in the era of tremendous federal debt, unlike the type that has never been seen before in human history. Federal spending is at a level never seen before in human history. And low interest rate environment that's never been seen in our country's history. What is all this going to do? Well, stay tuned in the next segment. We'll discuss this further, and again, how to weather the storm that's coming.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. I'm talking about some heavy stuff today, and I don't want to sound like an alarmist. In fact, I feel like I just look at things. Like I said, I've been accused of being a thinker. I take that as a compliment. The reality is I'm looking at the situation, and a lot of this is not coming from me, but it's coming from the concerns of people that I'm talking to. The people that are reaching out to me, looking at what's going on, seeing the financial and the economic and the government situation that we're in, the direction our country's going, all those different things. And then, like I said, the CPI report was alarming. 4.2% first quarter 2021 on an annualized basis, which was higher than the experts. Again, I can't believe anybody was surprised. Just look around, pay attention. We're already seeing inflation. We're seeing it in the grocery store. We're seeing it in building materials. We're seeing it in different areas. We're seeing it with gas prices, certainly. You know, it's hard to believe that more isn't to come. And the cause of it, one of the big causes, of course, is the extra money that's been pumped into the system, $6 trillion in the past year or so by our federal government. I mean, those kinds of things have consequences. You can't just pump tremendous amount of money at things and not expect nothing to happen. Something's going to happen, and in most cases, that something is bad. I caught a lot of flack last year, back in the beginning of March of 2020, when I started talking about COVID and actually how the economic concerns that I had that could happen as a result. I caught a lot of flack in the first few weeks until it became abundantly clear to everyone that COVID was going to be a big deal economically. And again, it wasn't all just coming from me. I'm not just not being all clairvoyant, okay? I do feel like I have a pretty good pulse on things, don't get me wrong, but I do a lot of research and I pay attention, and I'm dealing with people on a daily basis, average, everyday Americans. So I'm very close to the heartbeat of what's going on a daily basis with businesses, individuals, all that kind of stuff financially, and not just here in Arizona. I literally, my gosh, in the last week, I've talked to and worked with new clients everywhere from Seattle to North Carolina and everywhere in between. Again, a couple of reasons. Prior to COVID, I was traveling the country speaking to various investor groups about the personal bank concept, how you could create a high cash value policy, create dividends around 6%, access the funds from a bank line of credit, access them at a lower rate, currently 3 to 3.95, so pick up that 2 or 3% positive arbitrage and use that money to invest, pay off bills, whatever it is you want to do with. And a lot of people saw that and immediately understood the benefits and took advantage of it. And so I have clients literally all over the country. So I have a bit of a benefit and somewhat unique in that I'm talking to individuals and business owners literally across the country. No offense to other financial advisors, but most of them, most of their practice, the people they deal with are local. Not all, but I would say in most cases, the vast majority. So they'll get a view, they'll have a good handle on a local view of what's going on, but not necessarily more on a national level. And I can tell you this much, like I was talking to some folks today in Seattle who are business owners and some folks the day before in North Carolina and a client here in Arizona. And I can tell you there's a marked difference in between the different states right now, what's going on, business-wise, economic-wise, and everything else. It's having an effect on our economy. It's having an effect on the way things are going. And the biggest concerns people have right now going forward is inflation. I believe that needs to be one of the most valid concerns that anyone should have who's trying to make money, invest money, put money away for the future. Inflation can be insidious, and it can certainly eat away at your buying power and your ability to, again, earn, put away, and pass money on. You need to have an inflation strategy. And it's common knowledge. This is not a secret. But things like the stock market historically suffer in a higher interest rate environment. Not all stocks, not all companies, but a majority do. We're seeing some, like I said, recent jitteriness in the markets as a direct reflection to things like Janet Yellen and starting to speak the word, just speaking the words about future and potential future inflation is causing concerns, as it should. Having a diversification strategy, having a financial tool that actually does well in low interest rate environments, as we've seen in the last 12 years, but does even better in normal or even higher interest rate environments because they're interest rate sensitive in terms of the rate of returns. The positive arbitrage historically has been similar between the dividends earned and the interest charged. Historically, you get a positive arbitrage of 2 to 3%, irregardless of the interest rate environment. This is important to understand, so stay tuned in the next segment and we'll dive into this a bit further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Okay, we're going to wrap this up today in Your Personal Bank Show. Welcome back. We're talking about inflation, concerns that people have going forward. And I think I need to back up a second. A lot of times when I talk about that with a lot of folks, and if you're an expert on inflation, I apologize. This will be maybe a refresher. But I find most people haven't received or learned or the basic financial literacy that they probably should have. It's not taught in our schools. Sadly, most homes don't teach it. Most of us grow up middle class, let's face it. Most people, not all. But, we learn from our parents mostly, and if they kind of struggled financially and never got ahead, so to speak, never learned the lessons themselves, it's kind of like if you've never learned it, how do you teach it? You know what I'm saying? So I was not blessed with that either. Had to learn it along the way. And through School of Hard Knocks, learning through business ownership. I'm an entrepreneur at heart. I've actually owned 4 businesses. I've owned a retail business. I've owned a service company. I've owned a real estate investment company. And, of course, I own the financial insurance agency for the last, 17 years now. And I've had to learn some of these lessons the hard way myself. Inflation is something that's everybody is familiar with the term, certainly. Most people understand it's not a good thing. But I find most people really don't understand fully how it works or the effect it has. In a direct, most simple, way to look at it or understand it is, the costs of things that you buy goes up. It costs more to buy, hamburger in the store, for example, or can of corn or whatever. Those are things that have, increased in costs recently. Or fill up the tank of gas. Those are things that people see most directly and most immediately. Oftentimes, folks don't really fully understand the reasons behind why that tank of gas, why does it cost more per gallon, things like that. And in a simple, basic economics 101 is there's more dollars chasing the cost than there's the product or service. So if there's more dollars, it's a law of supply and demand. It's a basic law of supply and demand. The more people, the more dollars chasing an item, the more the item costs. The less dollars chasing the item, the less it costs. And that's pretty basic bottom line. Why are we seeing the inflation that we're seeing? Well, there's a number of reasons, but one of the primary ones, frankly, is quite simple. I've stated this many times. When the federal government adds $6 trillion, forget the politics for a minute. This isn't political, okay? And I hope no one takes it that way, and I hope you can get past it. I'm talking about economics, basic economics 101. By the way, both parties voted for some of the stimulus, so it cuts both ways. So forget the politics for a minute. When $6 trillion are added into the system that of money, transaction of money, buying and selling and all that, that's a huge increase in the amount of dollars that are floating around, so to speak, that folks have to purchase and spend and buy and sell, okay? That's a big reason why the value of each dollar decreases and the cost of things increase, okay? It's really that simple, okay? The thing is, if you're an investor, if you're trying to put something away for the future, where do you put your money? Where do you put your investments? Well, historically speaking, I've said in some of the other segments already, and if you missed it, go to yourpersonalbank.com. You can listen to any of the previously recorded shows, by the way. Pass it on, whatever. The thing is, certain assets tend to suffer and struggle, and other assets tend to shine. I've talked about owning tangible assets. Real estate, for example, is one of the most familiar and tends to do well with higher inflation because it's a tangible item, so the price of houses tend to go up. Now, the offset to that is purchasing homes tends to become more difficult when the interest rates are higher because, it costs more to service a loan. Okay, so sort of a double-edged sword with real estate in terms of interest rates. If they get too high, when you get into like the 70s type of situation, real estate suffered because interest rates were so high. A mortgage was extraordinarily expensive, and that decreased the value of property, real estate, because it costs so much to finance it to purchase one. So even though it was a tangible asset, that double-edged sword of interest rates and inflation can offset and cause real estate to go down in value, actually. One of the best ways to offset higher interest rates, inflation, because inflation and higher interest rates tend to go hand in hand. In other words, when things are heating up and the economy is starting to grow too fast, the Federal Reserve tends to increase interest rates to slow that down. When the economy is too slow or sluggish, they tend to lower interest rates to speed things up. Now, as the cost of borrowing is cheaper, like we've seen the last decade or so, because we had a sluggish economy coming out of the Great Recession, and the Federal Reserve was trying to boost the economy, increase purchasing and borrowing, and the cost of borrowing, they reduce the cost of it. So it's kind of like grease or it makes grease on the wheels to make things move a little smoother and easier. Okay, that's the idea, and it did work to a point, a great degree, and frankly, in my opinion, they kept the low interest rates for far too long and have then, in essence, help fuel a stock market bubble. I don't think anyone can argue with, we've repeatedly seen all-time highs recently in the markets on a regular basis. And a lot of that is fueled by the low interest rate environment, the low cost of borrowing. Companies can do business they can borrow money at a very cheap rate to expand, grow, build, whatever, creating more profits, which increases the stock prices. I mean, it's basic, again, economics 101. When inflation starts kicking into gear, though, to slow things down, the Federal Reserve typically then starts to increase the rates because things are overheated. You hear those terms, going too fast, too far, too fast. And, when costs of things start getting too expensive, people start getting upset. People don't like paying a lot more for food or clothing or housing or gas or anything else for that matter. And, the population starts to get frustrated and upset. And, you can pretty much, when it comes to politicians, I've said this so often, irregardless of who they are, what political stripe they may be, but the reality is, for the most part, they want to be reelected. And I think it was Bill Clinton that famously said, it's the economy, stupid. He's right. When people are upset, things aren't going well, and they're paying a lot more for things, they're not happy, folks tend to get voted out of office, okay? They tend to get replaced. They tend to get blamed for those kind of things and get replaced by somebody else who can promise them something different. It's kind of interesting because, frankly, a lot of politicians don't have a lot to do with inflation, the economy, or anything else for that matter, but they tend to take credit for it, of course, and obviously get the blame for it also. The Federal Reserve actually has a lot more to do with it. They can't totally control it either, but they have more influence. Again, how do you offset this? One of the best ways I've seen in my career and before, looking historically and everything else, is have an investment that's highly interest rate sensitive. Bonds certainly have that capability. Your personal bank policies do too. The advantage your personal bank has, I believe, is quite simple. You have underlying guarantees. That's a big deal when you're talking about markets and changes and interest rates and taxes, where the value of assets could certainly be affected and could drop. So having some underlying guarantees, reducing market risk is a big deal. It's really important and also a good diversification strategy. The other advantage personal bank has over a lot of other things is you've set it up properly. You can grow. It's income tax-free growth, access, and pass on to the heirs. Look, if you believe taxes are going up in the future, as most people do, and our current administration has repeatedly stated they want to do, then having a tax-free bucket of money makes more and more sense going forward. The higher the taxes, the more it makes sense. If you have a question about that or want to learn more about that, I've recommended this book multiple times. It's called The Power of Zero by David McKnight. You can purchase it anywhere. But I encourage you to read that. If you have an IRA or 401k, you need to read the book, The Power of Zero, again, by David McKnight. You need to read that book. And then contact me at yourpersonalbank.com to answer some questions on how to create yourself a tax-free bucket, a tax-free strategy, a tax-free diversification financial tool. Your personal bank is one of the best ones you can do out there. The last thing about it that's really strong, or not the last thing, but one of the other reasons is, the positive arbitrage. Look, that's kind of where it puts, as in terms of the financial arena, really puts it in a different league, basically unique. The ability to actually grow your money, earn dividends, and then access the funds through the bank line of credit at a lower rate than what you're earning, and keeping the difference. And the big key to this, here's the big secret. And if you understand this basic key, this the most important key of the whole thing is, if you understand it, you get the whole thing. So if you're kind of sort of paying attention and what I've been saying sounds kind of interesting, or you want to get more information and reach out to me and all that stuff, that's great. But I'm going to just say this. I want to encourage you to pause for 10 seconds, and I'm going to tell you the big secret here, okay? And the secret is this. The positive arbitrage that you're earning, the difference you get to keep, or what you're getting paid dividends and what you're earning interest, the amount you get to keep, is on money you spent. I'm going to say that again. You earn positive arbitrage on money you spent. In other words, you took those dollars and you allocated them elsewhere. You invested in other things. You purchased items. You paid down debt, whatever it is you did. But those dollars are gone and out of your pocket. They're out of your hands and they're elsewhere. Every other financial situation scenario that I've ever come across, basically, once you spend money, it's gone, right? It's out of your pocket. It's gone. Your return on that money. Now, you may have traded those dollars for an asset that'll give you a return. Okay. But those dollars are gone. They're not going to earn any interest for you going forward, are they? The amount of interest you earn on those dollars becomes zero, nada, nothing. The asset may grow in value, but the dollars stop working for you because you don't have them in your control anymore. You gave them away or traded them for something else. Here, you can do that and still earn interest on them. Keep the positive arbitrage. Keep the difference. Contact me at yourpersonalbank.com for more information, because that's where we can really get into it and show you how you can increase the amount of money that you keep in your pocket each and every month, each and every year going forward for the rest of your life. And not only that, how about this? What about passing it on to the heirs? Do you have any loved ones that you want to make sure that you get something to them? Okay, when something happens to you? Well, there's no stronger tool than your personal bank. Life insurance is the strongest tool, period, to pass on assets to the next generation on a tax-favored basis. In fact, in most cases, tax-free. If you get up over the estate limits, which are, right now over $5 million a person, there are other tools like ILITs, life insurance, irrevocable life insurance trusts, that can extend those limits even further. It's perfectly legal. It's all in the tax code. We follow the rules. We're not playing any games. Okay? My point is, you can create a diversification strategy. You can create a separate bucket of money that has guarantees, has safety, is not going to lose value if we see a change or a correction in values, whether it's the market or cryptocurrency or real estate or anything else for that matter. On top of that, you're going to have access, liquidity, use of those dollars. On top of that, you can grow and access those monies tax-free and pass them on to your heirs tax-free. Again, you have to set it up properly. Of course, we show you how to do that. And lastly, you can use those dollars while you're alive, during your lifetime, and earn positive arbitrage. Keep the difference. As always, stay tuned to the Your Personal Bank show and contact me at yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.